As a financial planner, I get asked a lot of questions. One of the key questions I get asked is whether or not there's any downside to owning corporately owned life insurance. So by the end of this video, I'll give you the necessary information on corporately owned life insurance so that you can make an informed decision to see what's in the best interest of you and your family. My name is John Moakler, and I'm the founder of Moakler Wealth Management. And for the best advice on how to protect you and your family, subscribe to my YouTube channel and hit the bell notification so you'll be notified when we launch a new video. The short answer to this question is there really is no downside to owning corporately owned life insurance. However, let's take a look at an example. So if you own a personal life insurance policy today, you're the owner, you're also the life insured, and either your spouse or your children are the beneficiaries. And so if something happened to you and you passed away, a death benefit, tax-free, would be paid to your spouse or to your children. If, on the other hand, that policy was corporately owned, then the corporation would be the owner, you're still the life insured, but the corporation becomes the beneficiary. And so if something happened to you and you passed away, the death benefit goes into the corporation, but it goes into a special account called the Capital Dividend Account, or CDA account, and all proceeds coming out of the Capital Dividend Account are tax-free. So in other words, there's no downside to owning corporately owned life insurance. In fact, one of the key benefits to it is cash flow. Because if you're a business owner, depending on which province you're in Canada, you either have an 11% or 12% small business deduction on the first $500K of active income inside your corporation. So as a business owner, I'd rather be paying for that life insurance with 11 or 12 cent dollars instead of my own personal tax rate, which might be 35 to 40 cents on the dollar. So it's just more tax efficient to owning the insurance, and there's no downside from a standpoint of the death benefit going to your beneficiaries. The second question I get asked a lot is whether or not we can move or sell an existing personally owned life insurance policy into the corporation. Well, the short answer is yes, but you would need to engage with a specialist such as myself in order to determine if there's any huge tax implications in moving or selling that policy to your corporation. Leave a comment in the link below and let me know if you have corporately owned or personally owned life insurance and whether or not you're looking at trying to move a personally owned policy into your corporation. Also take a look at the other video in the link. It's called Split Dollar Critical Illness. It's specifically for business owners. It's a great way for getting critical illness coverage on you and some of your key family members, but it allows the corporation to pay a portion of the premiums. And then if you surrender the policy down the road because you did not get a critical illness, you're able to get 100% of the premiums back, both what the corporation paid and what you paid, 100% tax-free. So it's a great way to get coverage, but it's also a great way to get money out of the corporation on a tax-free basis. Now back to a more detailed answer on whether or not you can move or sell a personally owned life insurance policy into your corporation. If you have a term policy, such as a term 10, term 20, or term to 100, these types of policies are the cleanest to move inside the corporation because they do not have a buildup of cash value. So you would need to hire a third-party valuation company to come up with the value of the policy, because that becomes the market price that you're going to sell it to your corporation, and then you're able to take that money out of the corporation on a tax-free basis. If, on the other hand, you have a permanent life insurance policy, such as universal life or whole life, these are a little bit more complicated because they can have cash values built up inside of them. So again, you would need to hire a third-party valuation company to come up with the value, and then you would come back to a financial planner such as myself so we could crunch the numbers to see if it's in your best interest to move that policy inside the corporation. The good news is once you get the green light that you can move that policy into the corporation, that market value that the valuator came up with now becomes the selling price to your corporation, which means that's the amount of money you can take out of the corporation on a tax-free basis. And now that market value becomes a new cost basis for the life insurance inside your corporation. The third question that I get asked a lot has to deal with the passive income tax rules that the federal government came into place in 2018 that affects all small business owners across Canada. And what it deals with is that if you have more than 50,000 of passive income inside your corporation, it's going to affect your small business deduction. And so how does passive income get created? Well, it's investments inside your corporation. So if you have an investment account and you produce 50,000 or more of passive income on those investments, it's going to affect your small business deduction. So for every dollar over the 50,000, you lose $5 of contribution room in your small business deduction. And so once you hit 150,000 of passive income inside your corporation, you lose your entire 500,000 small business deduction. This is huge tax implications for all business owners across the country. Let's look into an example. Let's assume you have 125,000 of passive income inside your corporation. Well, that's obviously over the $50,000 limit that the Fed set. And so it's 75,000 over. So 75,000 times 5 is 375,000. Now that gets subtracted off of your 500,000 small business deduction. So in this example, instead of having a 500,000 small business deduction, you now have a 125,000 small business deduction because we had to subtract off the 375. And so the question is, do I have a solution for you? And the answer is yes. So in one of my next videos, I'll be educating you on other investment options inside your corporation that avoid the passive income tax rules, but it allows us to grow investments in a very tax-sheltered way and to create a pension plan for you in retirement. So take a look at that video where it's talking about creating a corporately owned pension plan. But when we pay you in retirement, the entire paycheck is 100% tax-free. This channel allows me to be passive about financial planning and strategies that affect small business owners from coast to coast. So if you're interested in learning more about corporately owned life insurance, or if you have a personally owned policy that you're looking at moving inside your corporation, click on the link below to apply to become my client, and then we can determine whether or not it's in your best interest to move forward. Also, if you like this video, give it a thumbs up, subscribe to my channel, and share the video. And I want to thank you for watching. And always remember, when we develop financial plans for our clients, we always make sure that their money outlives them in retirement.